Hello everybody, this is Kieran from CryptoBoost. Today we're going to look at the crypto market cap and talk about dead cat bounces, what they are, how to detect them, and how that influences your trading. So during the last few days we've had two nice tops at around $187 billion. We had a bit of a dip to $180 billion and a short recovery to $184 billion. So even though we do not know how the price will continue from here on, if it continues to decline before the previous low of 180 billion, then the 183 billion top will be considered a dead cat bounce. Now off to the definition. A dead cat bounce is a temporary recovery from a prolonged decline or a bear market that is followed by the continuation of the downtrend. A dead cat bounce is a small, short-lived recovery in the price. And the name actually comes from the fact that if you drop a cat from a high building, when it lands on the floor it will bounce a bit. So a bit of a morbid terminology, but let's not think about that too long. As long as you know what it means in trading, then you're good to go. So what does a dead cat bounce tell you? A dead cat bounce is a price pattern used by technical analysts. It is considered a continuation pattern where first the bounce may appear to be a reversal of the prevailing trend, but it is quickly followed by a continuation of the downward price move. It becomes a dead cat bounce and not a reversal after the price drops below its prior low. So a few limitations of the dead cat bounce is the fact that it can only really be identified after the fact, which means that traders notice a bounce after the steep decline beyond the previous low. So it's much less of an indicator of future price, but more you can look at it and see that the market is continuing a downtrend movement and might still be in a bearish scenario. On BTCEUR, I can show you a few examples of dead cat bounces that we've seen at the beginning of 2018. So at the end of 2017, beginning of 2018. So after the very lovely rally we had in 2017, on the 17th of December, the market turned the other way. So we had a very sharp decline in price. Here a small recovery, and again a very sharp decline in price and a small recovery. So these tops that you see here would be considered dead cat bounces, since even though there's a recovery in price, the trend is continuing and it's a downwards trend. Another example would be with ADA, Cardano USD, and on the 3rd of January 2018 we had a very nice top at $1.20 and a very sharp decline in price. Now the price recovered a bit to 36 cents. However, it sank and went below the previous low of 136, confirming a continuation of the downtrend. Now one thing that you could do is either you sell here on the way down if it passes through different support lines, or you could actually check here and see if it passes through certain support lines as well. For example, especially if it goes past the first low, then you know that the pattern is continuing. However, you might get caught up with a new dead cat bounce thinking it's a reversal. So basically dead cat bounce is also a very strong signal of the emotions of the traders in the market, since for example traders here, when the market is the stock is declining or the crypto is declining, people get fearful and don't want to lose out, so they start selling. However, when there's a trend reversal, they're also fearing of missing out on a potential reversal and gains, so they buy back in. So not only did they lose money by selling pretty low, they lose again money by buying in at a higher price, but the trend continues in a downwards pattern. So I think that's why it's very important to understand market cycles and Elliott waves, since they are a very good indication if we are in a downwards pattern, a correction phase, and so on, especially if you're looking at long-term investment options. Alright, that was it for the dead cat bounce. Hope you learned something new, and I'll catch you on the next one. Have a nice day. Bye bye.